The Pacific Northwest still looks beautiful from the outside. Mountains, rain, forests, tech cities, and quiet neighborhoods. But in 2026, the housing story is no longer simple. Some cities are cooling, some are still moving fast, and some are split street by street. In this video, I will show you where buyers are gaining power, where sellers are losing control, and which markets could quietly trap your money if you only look at the scenery. At number 1, I have put Seattle, because the figures I recently came across honestly made me stop and think. This is not a dead city. Seattle still has Queen Anne, Magnolia, Capitol Hill, and Ballard. Neighborhoods people know for views, older homes, walkability, coffee shops, tech money, and strong lifestyle demand. But here is the surprise. The citywide market is no longer acting like every house deserves a premium. Redfin shows Seattle's median sale price around $865,000, down 1.6% year over year, while homes still sell in about 12 days. That tells me demand is alive, but buyers are sharper. They are not rejecting Seattle, they are rejecting weak value. Now the deeper reason is confidence. Seattle still has money, but the money is more careful because tech jobs, office vacancy, mortgage rates, and full monthly payments are all being questioned. Zillow shows 1,857 homes for sale, 777 new listings, and 53.1% of sales closing under list price. That is buyer leverage. Then look at downtown pressure. Cushman & Wakefield's Q1 2026 report shows downtown Seattle office vacancy at 36.5%. So my advice is simple. Buy the exact neighborhood, not the Seattle name. Queen Anne and Magnolia can still hold lifestyle value, but condos near weaker office corridors need harder negotiation, lower fees, clean inspections, and a real exit plan. At number 2, we are talking about Portland, and my honest reading is this. Portland is not one market anymore. It is a city of pockets. In the Pearl District, the lifestyle looks attractive. Walkability, condos, restaurants, galleries, and downtown access. But the math needs caution. Homes data puts Pearl District's median home price around $449,950, with an estimated 20% down payment near $90,000, and principal and interest near $2,240 before taxes, insurance, homeowner association fees, and utilities. That is why I would pause before buying a weak condo there. The old saying fits perfectly. A cheap door can still open into an expensive room. Now compare that with Laurelhurst and Alameda. Laurelhurst has older prestige, historic homes, mature trees, and stronger emotional demand. Homes shows its median sale price around $908,020, with homes selling in about 29 days. Alameda is also strong, family-oriented, and known for established residential streets. Homes shows median sale price around $925,000, up about 5% over the prior 12 months. But Portland buyers are not helpless anymore. Axios reported that nearly 59% of Portland buyers in 2025 paid below the original list price, with an average discount of 6.6%. So my advice is clear. Buy strength in Laurelhurst or Alameda if the payment works. Negotiate hard in weaker condo-heavy pockets. At number 3, we are talking about Yakima. And this city is not falling because nobody wants to live there. The real issue is that Yakima depends on a very practical buyer. Local workers, agriculture-linked families, small business owners, and people who cannot play games with monthly payments. The way locals describe it is simple. Yakima still has value, but buyers are counting every dollar now. In West Valley, homes are stronger because families like the schools and suburban space, Homes shows West Valley around $432,900, with houses spending about 39 days on market. In Terrace Heights, the market sits around $390,000, with price per square foot around $212. That tells me demand exists, but buyers are careful. Now look at the other side. Barge Chestnut Historic District, Nob Hill, and downtown Yakima tell a different story. Barge Chestnut has historic charm, but small sales volume means liquidity risk. 1 week's sale can affect the whole reading. Nob Hill and downtown are more sensitive to condition, safety perception, repairs, and local income. The broader Yakima chart shows why. The city had a median sale price near $397,500, up 6.9%. But homes took about 55 days to sell, longer than last year. Yakima County unemployment was 5.6% in February 2026, and county median household income is about $70,656. My advice is clear. Buy West Valley or Terrace Heights only if the payment works. Negotiate hard on older homes and avoid weak blocks where resale may slow. At number 4, we are talking about Gresham, and I would start with Gresham Butte because it shows the stronger side of this city. This is the kind of neighborhood where buyers look for hillside streets, bigger residential lots, older established homes, and a quieter feel away from the heavier Portland core. Homes data shows Gresham Butte with a median sale price around $594,500, an average price per square foot around $254, and only about 1.6 months of supply. That tells me this pocket still has demand. But my judgment is simple. If you buy here, do not overpay for the Hillview unless the roof, foundation, drainage, and full monthly payment make sense. Now compare that with downtown Gresham and the story changes. Homes data shows downtown Gresham around $336,900 median sale price, about $280 per square foot, and around 4.4 months of supply. The price is lower than Gresham Butte, but the market has more hesitation, and the year-over-year sale price change is reported around -9%. Citywide, Realtor shows Gresham with about 454 homes for sale, a median list price around $489,000, and about 41 days on market. The cause is affordability pressure, Portland spillover, buyer caution, older home repairs, and neighborhood-by-neighborhood confidence. My advice: buy strong pockets carefully, but negotiate harder in weaker areas. At number 5, I want to talk about Spokane, because the numbers and what real estate advisors are saying really bothered me in the last few months. My friend who works with Northwest property investors told me frankly that Spokane feels like a value market and a waiting game at the same time. Spokane's typical home values have hovered near $395,000, and homes are going pending in about 32 days. Not frantic, not frozen, just careful. Meanwhile, the inventory has grown, and price negotiation power is shifting toward buyers in some neighborhoods. Spokane's local economy is stable enough with jobs in logistics, healthcare, and education, which keeps housing demand real, but buyers are doing deeper math because mortgage rates tied to the 10-year Treasury have climbed above mid-6%, meaning payments are heavier than many expected in 2026. The real causes here are classic structural forces and a national backdrop that every serious advisor is talking about. Across the country, mortgage interest rates have traded higher because the yield on safe Treasury bonds, the bedrock of housing finance, rose to levels not seen in months, squeezing buying power and slowing price growth. Locally in Spokane, this shows up as more price cuts, longer marketing times, and buyers pausing before making decisions. Some investors tell me they are watching rent versus purchase math very closely. Spokane's rents near $1,450 mean a gross rent multiplier that is thinner than, say, the coastal metros. Housing advisors I've spoken to say the smart move in Spokane right now is not to rush into bidding wars, but to focus on neighborhood consistency, inspection results, and real monthly payment comfort. Because just seeing a home look affordable on paper doesn't mean it fits your long-term finances. Tools like absorption rate, inventory change, and sale-to-list ratios matter now more than ever, and overlooking them is what traps unwary buyers. Let's move to number 6. Medford sits near the southern Oregon border, framed by scenic mountains, but carrying an unusual weight in its housing market. Driving through the valley, the first thing you notice is wildfire smoke lingering in the air. A constant reminder that climate risk here isn't theoretical, it's real. Over the past year, the median sale price has dropped roughly 4.5%, while the number of homes sold per month has fallen 20%, and days on market have stretched to nearly 65 days. Neighborhoods like Rogue Valley Estates, Jackson Heights, Bear Creek Village, and Medford Meadows have felt these shifts differently. High-end homes in Rogue Valley Estates are stagnating, while Bear Creek Village offers bargains for those willing to navigate insurance hurdles. Builder starts are down 30%, affordability indexes are at historic lows, and nearly 70% of families are priced out of the market. What does this mean for residents and investors? The collapse of the legal cannabis industry and inflation-eroding fixed incomes have reduced the buyer pool. Insurance availability is constrained, especially in wildfire-prone streets, forcing careful planning. My advice: if you live here or are considering investment, focus on Bear Creek Village or Medford Meadows, where prices are realistic and infrastructure stable. Avoid overpaying in Rogue Valley Estates for speculative luxury homes. The lesson is clear: study local data, understand insurance limitations, track days on market, and prioritize long-term stability. In meetings with local real estate advisors, the repeated consensus was that patience is your leverage. Don't chase inflated peaks, but buy where fundamentals, community safety, utilities, and economic diversity remain sound. Number 7. Tacoma. Tacoma, historically known as the City of Destiny, has long been the more affordable blue-collar cousin to Seattle. But as I examined the latest market data, the spillover demand from Seattle has created irrational pricing in neighborhoods near the port and downtown. Buyers who were priced out of Seattle drove Tacoma prices up sharply. Now, with Seattle softening, Tacoma is facing a double whammy: gridlocked commuters and thinning investor margins. Active inventory has nearly doubled, up 95% year over year, while closed sales have plummeted 22%. The median home price slipped roughly 5%, and foreclosure starts are up 14% in Pierce County. Average mortgage payments now consume over 45% of the local median income, making ownership nearly impossible. Even pending contracts are cancelling at 16%, and rental vacancies are creeping to 6%. For societies, streets, and actionable advice, neighborhoods like North End, Proctor District, Hilltop, and Ruston Way show contrasting conditions. North End still has strong community value, while Hilltop is struggling with price cuts and slow sales. Proctor District maintains steady demand, but Ruston Way is seeing investor caution due to high prices and low absorption. Based on meetings with local advisors and my own experience, I would tell buyers to prioritize Proctor District or North End for stable investment, monitor Hilltop for opportunistic purchases, and approach Ruston Way carefully. Leverage is now clearly in the buyer's hands, and understanding supply, pending sales, and mortgage affordability here is critical before making any move. I put Olympia at number 8, not because it's crashing, but because the latest numbers tell a subtle story that buyers and homeowners must understand. Recently, I saw data showing that home prices are nearly flat year over year, around $513,250, and homes are selling in about 46 days, which is slower than last year. Buyers are cautious, not absent. Meanwhile, listings are increasing and rental demand is rising, meaning the market is balancing out but not booming like before. The real cause here is local income pressure, affordability limits, and a mix of buyers holding off because monthly payments are higher now with mortgage rates tied to US Treasury yields. In meetings with local agents, the theme I heard was buyers want value, not panic buys. That means you should focus on strong neighborhoods like Pleasant Glade, Meadows, and Oak Tree, where community demand and schools still matter. At the same time, downtown Olympia and older inventory are showing slower sales. Those are the areas where buyers are winning price cuts. My advice to residents is clear. If you're planning to buy, be prepared to negotiate on price and repairs, and look at monthly payments closely before you lock in. If you already own, don't rush to sell. Align your price with local income realities and condition improvements. Olympia's market isn't dying, it's evolving, and only careful buyers and sellers will benefit. When I first considered including Salem in this list, I honestly hesitated. The city has long been seen as a stable government hub, but recent figures tell a more nuanced story. Over the past 2 months, I've tracked active listings climbing nearly 22%, while homes with price reductions surged past 34%. Days on market are now up by 15%, showing buyers are holding back at current mortgage rates. Median sale prices have fallen roughly 3% year over year, and foreclosure filings are up by 12%. Local investor activity has plunged 45%, highlighting that professionals see very slim profit margins here. From my perspective, buyers should tread cautiously, focusing on neighborhoods like West Salem or South Gateway, where long-term infrastructure and school quality still support value. The causes behind this correction are layered. Government wages alone can no longer sustain the previous price levels, and rising mortgage costs combined with tightening loan availability are discouraging typical families. Some streets still perform well, but mid-century ranches that once sparked bidding wars are now stagnant. My recommendation for viewers: consider waiting for deeper market absorption, evaluate local risk factors like rising property taxes, and avoid overpaying in overinflated areas. Salem demonstrates that even traditionally stable markets are vulnerable when economic insulation fades and leverage shifts to buyers. The last city is Bend, and this one is important because Bend is not weak in a normal way. It is expensive, beautiful, and still attractive. But the market has started punishing people who bought the lifestyle without checking the math. When I looked at the latest graphs, the figure that stood out was this. Bend's median sale price was around $681,500, down 7.9%, even though 170 homes sold, up from 148 last year. That means buyers have not disappeared, but they are no longer paying anything just to live near trails, breweries, and mountain views. Old Bend, River West, Northwest Crossing, and Aubrey Butte are the areas I would study very carefully before buying. My advice for people living in Bend is simple. Do not panic, but do not ignore the warning signs. River West is still strong, with a median price near $929,000, while Old Bend shows a very different story, with homes taking around 121 days to sell. Zillow's latest Bend reading also shows average home value around $735,193, down 2.5%, while Deschutes County unemployment was 5.6% in February. Then add wildfire insurance pressure, stricter underwriting, and higher ownership costs, and the lesson becomes clear. If you already own in Bend, price realistically, and protect your insurance. If you are buying, avoid emotional bidding, inspect deeply, and only buy where resale demand is strong.